Yeah.
Okay. Well, good morning, everyone. Welcome to this press conference on the World Economic Outlook. Delighted that you could join us today. Welcome also to our colleagues who are following us online. Let me introduce to you the speakers for today's press conference. We have to my right Geeta Gopinath. She's the Economic Counselor and the head of the IMF's Research Department. To her right, we have Gianmaria Milesi Ferretti. He's the Deputy Director of the IMF's Research Department. And then to his right, we have Oya Chelasun. She's the head of the division in charge of the World Economic Outlook in the Research Department. Geeta will have some introductory remarks, and then we'll be happy to take your questions. So with that, I'm handing the floor to Geeta, please.
Good morning and welcome everyone. A year ago, economic activity was accelerating in almost all regions of the world. 1 year later, much has changed. The escalation of US-China trade tensions, needed credit tightening in China, macroeconomic stress in Argentina and Turkey, disruptions in the auto sector in Germany, and financial tightening alongside the normalization of monetary policy in the larger advanced economies have all contributed to a significantly weakened global expansion, especially in the second half of 2018. With this weakness expected to persist into the first half of 2019, our new World Economic Outlook projects a slowdown in growth in 2019 for 70% of the global economy. Global growth softened to 3.6% in 2018 and is projected to further slow to 3.3% in 2019. The downward revision in growth of 0.2 percentage points for 2019 is also broad-based. It reflects negative revisions for several major economies, including the Euro area, Latin America, the United States, United Kingdom, Canada, and Australia. After this weak start, growth is projected to pick up in the second half of 2019. This pickup is supported by significant monetary policy accommodation by major economies, made possible by the lack of inflation pressures despite growing at near potential. The US Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England have all shifted to a more accommodative policy stance. China has ramped up its fiscal and monetary stimulus in response to the trade tariffs. Furthermore, the outlook for US-China trade tensions has improved as the prospects of a trade agreement take shape. Now, these responses have helped reverse the tightening of financial conditions to varying degrees across countries. Emerging markets have experienced some resumption in portfolio flows, a decline in their sovereign borrowing costs, and a strengthening of their currencies relative to the US dollar. While the improvement in financial markets has been rapid, those in the real economy have been slow to materialize. Measures of industrial production and investment remain weak for now in many major economies, and global trade has yet to recover. With improved prospects for the second half of 2019, global growth in 2020 is projected to return to 3.6%. This recovery is precarious and predicated on a rebound in emerging market and developing economies, where growth is projected to increase from 4.4% in 2019 to 4.8% in 2020. Specifically, it relies on an expected rebound in growth in Argentina and Turkey and a few other stressed economies, and is therefore subject to considerable uncertainty. Growth in advanced economies will slow slightly in 2020, despite projected recovery, partial recovery in the euro area, as the impact of US fiscal stimulus fades and growth tends towards a modest potential for the group, given aging trends and low productivity growth. Beyond 2020, global growth is expected to stabilize at around 3.5%, bolstered mainly by growth in China and India and their increasing weight in world income. Growth in emerging market and developing economies will stabilize at 5%, though with considerable variance as emerging Asia continues to grow faster than other regions. A similar pattern holds for low-income countries, with some, particularly commodity importers, growing rapidly, but others falling behind the advanced world in per capita terms. So while the global economy continues to grow at a reasonable rate, and a global recession is not in the baseline projections, there are many downside risks. Tensions in trade policy could flare up again and play out in other areas, such as the auto sector, with large disruptions to global supply chains. Growth in systemic countries, areas like the euro area and China could surprise on the downside, and the risks surrounding Brexit remain heightened. A deterioration in market sentiment could rapidly tighten financial conditions in an environment of large private and public sector debt in many countries, including sovereign bank doom loop risks. Given these risks, it is imperative that costly policy mistakes are avoided. Policymakers need to work cooperatively to help ensure that policy uncertainty does not further weaken investment. Fiscal policy will need to manage trade-offs between supporting demand, protecting social spending, and ensuring that public debt remains on a sustainable path, with the optimal mix depending on country-specific circumstances. Financial sector policies must address vulnerabilities proactively by deploying macroprudential tools such as countercyclical capital buffers, a task made more urgent by the possibility that interest rates will remain low for longer. Monetary policy should remain data-dependent, be well communicated, and ensure that inflation expectations remain anchored. Across all economies, the imperative is to take actions that boost potential output, improve inclusiveness, and strengthen resilience. There is a need for greater multilateral cooperation to resolve trade conflicts, to address climate change and risks from cybersecurity, and to improve the effectiveness of international taxation. This is a delicate moment for the global economy. If the downside risks do not materialize and the policy support put in place is effective, global growth should rebound. If, however, any of the major risks materialize, then expected recoveries in stressed economies, in high-debt economies, in export-dependent economies may be derailed. In that case, policymakers will need to adjust. Depending on circumstances, this may require synchronized, though country-specific fiscal stimulus across economies, complemented by accommodative monetary policy. Lastly, adequate resources for multilateral institutions remain essential to retain an effective global safety net, which would help stabilize the global economy.
Thank you very much, Geeta. So we'll try to get to as many questions as possible and cover as many countries and regions. So I'll start here in the second row. The gentleman right there. Yes, please.
Hello, it's Chris Giles from the Financial Times. As you said, the recovery you're predicting is for the global economy is precarious and there are many risks around. How much ammunition do you think there is left in monetary policy to address the risks if they do come to pass? And how big should any coordinated fiscal stimulus be, which you mentioned right at the end, again, if it is needed?
Our baseline forecasts are for global growth to recover in 2020, but indeed, this is precarious and there are serious downside risks. Monetary policy space varies across countries in the world. For many advanced economies, it remains limited, and we would expect to see unconventional monetary policy tools being used, for instance, in the euro area. Now, on the plus side, inflation pressures stay low, so there is the possibility for monetary policy to be even more accommodative. On the fiscal side, again, this is going to be very country-specific because it depends upon the fiscal space that countries have. If the downturn turns out to be much more severe than what's in our baseline projection, we would expect a synchronization in fiscal spending because that would be more effective, given that I think it would be better in terms of boosting confidence, and also it would mitigate some of the negative spillovers from imports. But that said, the actual magnitude of that is going to depend on the circumstances and going to depend on the country.
Thank you very much, Geeta. So we'll go here to the first row. Gentlemen, yes, please.
Hi, I'm Anup Roy from Business Standard India. In this, because of this trade war, there was a concern that currency war could take place, but that didn't really happen. But of course, the emerging market currencies witnessed some pressure. Indian rupee depreciated a lot. So do you think in this globally connected world, this currency war situation is a real possibility, or it is losing relevance?
In the early part of 2018, we did see, in response to a combination of factors, but not just trade tensions, but also the increase in oil prices, that several emerging markets face pressure on their currency. This remains, I mean, the volatility of the exchange rates will remain in the event of further downside risks being realized. The question of what kind of, what will be the impact of exchange rates on trade, I think what we have to keep in mind is that exchange rate movements are driven a lot by monetary policy in different countries and driven a lot by, financial risks. And so it's very hard to pin down the direction of exchange rates for any of these regions going forward. What we have seen is that with the more accommodative stance in monetary policy in many of the major banks, we have certainly seen emerging market currencies strengthening relative to the US dollar somewhat, partially. And as long as things stay relatively stable, that trend might persist.
Thank you, Geeta. So we're going to stay on this side of the room, and then we're going to swing the gentleman in the second row right there. Yes.
Good morning, Roberto Petrini, La Repubblica, Italy. What's your view about Italy, high debt and very, very low growth? And do you think that Italy is a risk factor in international economy? And Italian government would be introduce a flat tax in Italian economy. What's your opinion about this? Thank you.
The second half of 2018 was particularly weak for Italy. I mean, Italy was in a recession, and that weakness carries over into 2019. The concerns that remain have to do with the high levels of debt, with the higher levels of sovereign borrowing costs, banks' costs of borrowing, and all of this is reflected in weaker investment in Italy. So these are risks to keep in mind, especially given that growth in Italy is weak, not just in real terms, but in nominal terms, which means that we are projecting debt to, as ratio of GDP to increase in Italy going forward. To your question about the flat tax, we would have to wait to see what the details are about the particular nature of that tax before we can comment on it.
Thank you. So we're going to swing to this side of the room. I'm going to take the lady in the third row with the pink jacket, please.
Hi, People's Daily from China. I have a question about trade deal. How do you see the U.S.-China trade conflicts its impact to the global economy? And if they reach a deal, how do you see its significance to the world economy? Thank you.
The escalation of trade tensions between the U.S. and China was certainly one of the important factors weighing on growth towards the end of 2018. We've certainly seen a truce, and we've certainly seen negotiations going on, and we hope that there will be an agreement soon. The nature of the agreement is unclear. We will have to wait to see what the specific details are going to be. But as we've said on many occasions, any improvement on trade relations, multilateral cooperation on this front, making sure that there is some sort of a durable resolution of trade uncertainty would all be very positive for global growth.
Thank you. So we continue to swing, and the young lady here with the... Yes, please. Violet.
Hello, my name is Yolanda Morales. I'm from Mexico in El Economista newspaper. I want to know your outlook for Mexico now that we have a new president that has different ways to direct the economy. Thank you.
With Mexico, we've revised down our growth for Mexico for both the 2019 and 2020, and this is both relative to last October and last January. There's a combination of factors for this. One, monetary policy has been tighter than previously expected, and the second has to do with policy uncertainty around policies of the new government, which is weighing on investment. So this would continue to be a factor, especially the policy uncertainty would continue to be an important factor going forward for the growth outlook for Mexico. And I'm going to hand this over to Gian Maria, who might want to add something. Would you?
Yes, clearly Mexico has also been affected over the past couple of years by the trade tensions with the United States. Those have been mostly resolved, but new trade agreement is not ratified. That had resulted in exchange rate pressures, in turn leading to a tighter monetary policy, which is one of the factors that has been weighing on economic growth. But clearly uncertainty is an important factor, both also on the domestic front, as Gita has just stressed. Thank you.
Thank you. So we're going to continue to swing. The gentleman in the second row. Yes, please, sir. Yeah.
Hello, Larry Elliott of The Guardian. You have some Brexit alternative scenarios in your WEO, which talk about quite a significant deviation downwards from the baseline. How serious do you think the risks are of a no-deal Brexit, and what would the consequences of it be?
The situation clearly is in flux, as we all know, on a daily basis. So it is hard to predict where all of this will end up. But what we have seen is that we've seen the negative consequences of the uncertainty surrounding Brexit, which has weighed on investment in the UK and is one of the factors for our downward revision of growth for 2019 for UK. We've also done our estimates of the long-term impact of a no-deal Brexit, which would mean a relapsing to WTO tariff rules, and they are quite substantial in the order of magnitude of about 6% for the UK and about 0.5% for the EU. And so these are large effects. We hope that there will be a deal soon. We are all watching the events as they unfold, but it is a little difficult to predict at this time where everything is headed.
Thank you, Gita. So I'm going to take two more questions on this side, and then we'll come back. Efe on the third row.
Hi, thank you so much, Alex Segura from Agencia Efe. You've cut 0.6% your forecast for Latin America for this year. Both Brazil and Mexico forecasts have been revised down, and the situation in Venezuela just keeps getting worse. So what is your overall opinion on the region? Thank you.
So the region as a whole, the last half of 2018 was weak, and a lot of that is carrying over into 2019. So we have revised our estimates down for Brazil and for Mexico. Of course, the reasons are different in both cases. In the case of Mexico, it's a combination of policy uncertainty and monetary policy tightening. In Brazil, it is tied to policy uncertainty and about the postponement of the reforms on the fiscal front. For Venezuela, of course, it is a great humanitarian crisis of, social economic crisis, and we're seeing a very major contraction for Venezuela. If you would like to add something.
No, as Gita said, for Venezuela, it's very hard to make predictions at this point, and it's a humanitarian crisis, food crisis, medicine crisis. One worry is that oil production is plummeting, and that has led to our downgrade for that country.
Thank you. So we're going to take one last question on this side. We're coming back. Second row, Bloomberg, please.
Hi, Andrew Maida from Bloomberg News. Can you talk a little bit more about your forecast for the U.S. economy? To what extent do you see, how do you see the sugar high of the fiscal stimulus coming off? And then specifically on the Federal Reserve's monetary policy, to what extent do you think their positioning is appropriate? A lot of people have been weighing in on that recently, including the President of the United States.
So the U.S. economy, in our forecasts, will slow in 2019 and then slow somewhat more in 2020. This is to be expected as the effect of the fiscal stimulus fades, and so that is one of the important reasons for the decline. At the same time, the more accommodative monetary policy stance is helping with growth in 2020. To your question about monetary policy, we fully endorse the view that any central bank takes a very data-dependent approach, which is well communicated. So depending upon the data that comes up, I think it's important to respond with the path of interest rates.
Thank you. So we're going to come back here. The lady in the orange jacket, right there at the back. Yes, thank you.
Hi, my name is Leah, and I'm from Nigeria. I'm wondering, the trade wars, how is it going to affect sub-Saharan Africa in 2019? Thank you.
For sub-Saharan Africa, there is the impact that comes from trade wars, but there are also impact of the trade war on global growth, which then spills over into oil prices. So for instance, for Nigeria, the important price that does matter is what's happening to commodity prices. And if, because of the trade tensions, there's going to be a weakening in global growth, that can have a larger negative effect. Would you like to add something on sub-Saharan Africa?
No, absolutely. It's the commodity prices which are being weakened by somewhat weaker global activity and directly demand as well.
Thank you. The lady here in the fourth row, in the middle. Yes.
Shayma Ahmed from Egypt. You mentioned many risks in the future. So what are the main risks for the emerging markets, among them Egypt? Thank you.
Thank you.
Well, trade tensions are clearly one for the more open, particularly for the more open economies in the emerging world. It would be a direct effect. There is an indirect effect through market sentiment. We saw towards the beginning, towards the middle of last year, a swing in market sentiment away from emerging economies that has caused substantial outflows, particularly of short-term capital, from more vulnerable economies. Those are clearly very important risks. I think one should also highlight more generally the risk of geopolitical conflict and strife that unfortunately is still affecting a number of countries, particularly in the emerging world, and taking a very heavy toll, first of all on a humanitarian basis, but also in terms of aggregate growth. as Gita just mentioned, of course, for countries more reliant on commodities, and again, those are predominantly in the emerging world, weaker global growth and particularly weaker demand from China could be associated with lower commodity prices, which could put additional stress on current accounts, on public finances of many emerging economies. This is just a few of the potential downside risks that we could see.
Thank you. So we're coming back in the first row here. The gentleman, yes, please. Yes, Barry.
Barry Wood, Barry Wood, RTHK in Hong Kong. Ms. Gopinath, when you list the factors that have contributed to the significant weakening of the global economy and of trade, how would you apportion that? Is it primarily U.S.-China trade and tariffs that have led to that deceleration?
The U.S.-China trade tension is a contributory factor, but there have been other factors. So, for instance, in China, for much of 2018, the bigger factor was the tightening in credit. That was needed because there needed to be greater regulation of the shadow banking sector. So that, for much of 2018, that was the driver for China. The trade conflict plays out only pretty much towards the end of 2018. The other important factors have been also country-specific. So for Germany, the decline had to do with the auto sector, with the new emission standards there. You had, in Japan, you had a few disasters, natural disasters, and that weighed on growth too. But the general sentiment and the concerns about the trade conflict have weighed on confidence, on business confidence, on consumer confidence, and that has affected more countries than just the two over here. So I think that is an important factor to keep in mind, especially in terms of, as I mentioned before, that there needs to be a durable solution to the trade tensions and to ensure that it doesn't escalate into other sectors.
Thank you, Gita. So we're going to take one more question on this side. The gentleman in the first row. Yes, please.
Hello, Ricardo Leopoldo, Agência Estado. Ms. Gita, could you give us a little sense about how important is the social security now in Brazil? Because you mentioned that one of the reasons of the downgrade of the Brazilian projection from 2.5 to 2.1 this year is a kind of postponement of this fiscal reform. So in your projections for the Brazilian economy, 2019, 2020, you consider that the Social Security reform is going to be approved by the Congress this year?
It is. Firstly, it's very important to have the right level of social security for the most vulnerable population in any country. It, of course, has to be fiscally prudent, and in the case of Brazil, it is indeed the case that the debt levels are somewhat unsustainable, and so pension reforms would be required. That got postponed some into 2019. It's hard for us to tell the exact date or the time when the implementation will happen. So that's difficult for us to forecast at this point, but we are expecting some resolution in the next year or so.
That's right. We're expecting it to pass sometime in 2019, and what we've done is to shift growth somewhat from 2019 into 2020 on account of that.
Thank you, Oya. So I'm going to move back to the middle row here. So I'm going to go all the way back. The gentleman in the purple shirt. Yes. Right there.
Hi, Jason Lang with Reuters. You mentioned in the report that China may need to undertake fiscal stimulus to avoid a severe downturn that could derail its reform agenda. How much fiscal stimulus beyond that which is currently contemplated, or at least publicly known to be contemplated, do they need to do, and how critical is the risk of that severe downturn? Thank you.
So in our In our forecast, we expect China to continue to slow. It's a gradual weakening of growth, but this is to be expected. It is a needed transition from a very high growth, investment-driven, credit boom-driven growth towards one that is more sustainable, and it will involve credit, a weakening in credit growth, deleveraging. All of those factors we expect will slow down growth. I mean, the Chinese government has put in a substantial amount of monetary and fiscal stimulus already. We are seeing some green shoots there in terms of recovery. If you look at the manufacturing PMI for China, the most recent numbers shows that there has been there's been a recovery there, and so we are seeing positive signs already. What would be needed in a more severe crisis would, of course, depend upon what the nature of the issues are, but the exact numbers would be very hard for us to comment on at this point.
Thank you. So we're going to go back to the middle row. The gentleman in the brown jacket. Yes, sir. Yes, please.
Thank you very much. Marlon Madden, Barbados Today. Could you give us an assessment for the Caribbean region, please? And given that most of our economies are tourism dependent, and if you could single out Barbados, we're currently in an IMF program. What's your outlook?
So for the Caribbean, we always have a diversity. We have more commodity-dependent economies, and we have economies that are less commodity-dependent, more dependent on tourism. This latter group is doing somewhat better. Their prospects are typically tied to advanced economies, so there has been some softening, but generally growth is stronger. The commodity-dependent ones are still in a process of adjusting to the lower commodity prices, some of them oil prices. For Barbados, we have an IMF program, so the prospects are that activity strengthens somewhat with the buildup of confidence as the program is implemented. It's essential for that to happen, to return to positive growth in 2020, that the targets are met and the reforms are steadily implemented.
Thank you. I'm going to go here to the first row. Yes, sir. Right there, the gentleman there.
Thanas Koukakis in Greece. In your report, you changed significantly your estimations about the Greece's current account deficit. To be precise, now you believe that, according to your report, it will be 5 times larger than you projected 7 months ago. So is this related with the wider environment in the Eurozone and the pressures on the experts of the region, or have to do with the legacies of the crisis that the country must tackle?
I think it's a combination of factors. I understand there were some data revisions which also contributed to drive up the current account. We've had a resumption of growth, which is a good thing, but it tends to increase demand for imports. But I think there are literally also statistical issues at play that had to do with data revisions.
Thank you. So, I'm going to take a question online before we move to the right-hand side of the room. So the question is on the MENA region. Did the IMF revise its growth forecast for the MENA region and the UAE in particular?
Yeah. So if we compare what we were forecasting in October to what we are forecasting now, we see that particularly for 2019, there is a sizable difference in the predictions for the oil price. In October, we were expecting, based on futures prices, oil prices to be about $70 a barrel. In 2019, they're over $10 lower now. And that, of course, implies a downward revision for oil exporters in general. Now, you have a bit 2 categories of oil exporters. You have some that are also suffering from a variety of other factors, including geopolitical tensions and strife. This is clearly not the case for the UAE, but we do have a downward revision, which is driven, as I said, by the lower oil price, it is about 1 percentage point, a bit less than 1 percentage point down the revision for 2019 and a little bit less for 2020. So the forecast is for growth to be just below 3% for 2019, just above 3% in 2020. But of course, again, oil price, agreements to restrain oil production to support prices for 2019 and more generally weakening of global demand are the main factors at play.
Thank you, Gian Maria. So I'm going to go to the second row here in the middle. Lady in black. Yes, please.
Hi, Grace Blakely from the New Statesman in the UK. To what extent do you think financial markets have priced in the downside risks associated with climate change and also the kind of weakening of various other environmental systems? Or are we kind of facing what some have called a carbon bubble? And to what extent have you accounted for that in the WEO this year?
I mean, climate change is clearly an important risk. Medium term, it seems to be moving up closer as every month goes by. It is an important risk for low-income countries. In fact, it's one of the risks that we flagged that requires addressing urgently. When we've seen natural disasters around the world, and those are playing out, which are weighing negatively on growth. So this is a very important factor going forward. There is an attempt to incorporate some of these risks when it comes to thinking about the forecast going forward. I mean, not just by us, but by major central banks around the world. There is this sense of looking at resilience to crises, to climate risk crisis, so kind of stress tests that take into account the risks that come from climate. That is also something new that we are seeing these days, but we expect that to continue going forward in the years to come.
Thank you. So we're going to swing on this side of the room. The lady in the gray jacket. Yes, first row. Yes, please.
Hi, my name is Gulnoz from Uzbekistan. I'm interested about Central Asia region. What kind of risks or challenges do you see in that region? Thank you.
Yeah, sure. It's a very differentiated picture in Central Asia. So you have economies like Kazakhstan or Azerbaijan heavily dependent on oil prices, whose outlook, of course, is heavily affected by what happens to commodity prices. You have economies like Uzbekistan, where have more a different set of a different type of commodity dependence, more exports of cotton, for instance, but also pretty extensive opening up and reforms of the economy and a growth forecast that hovers around 5%. So again, a picture that is quite different across countries and very much dependent on what happens to the price of their main exports, as well as to issues of domestic stability and internal external strife in some cases.
Thank you, Gian Maria. So we're going to take two more questions. I'm going to take the gentleman in the white shirt right there in the second row. Yes, please. And then we're going to come to you.
Thank you very much. My name is Masaki Kondo, GG Press from Japan. My question is Brexit. There was a question before, but I think it's a near-term risk. Let me ask again. There's analysis on box 1, and you put the scenario A and B, moderate scenario and the more severe scenario. I don't see the severe case scenario. Can you just explain how much negative impact you would expect? And then second question, if I may. Again, I would like to ask your opinion about modern monetary theory, MMT. Thank you very much.
So on the analysis that we did for Brexit, we looked at two possible no-deal scenarios. The difference across the two had to do with whether in the short term there would be disruptions at the border. And how severe any financial disruptions would be. So the scenario B, which is a worse scenario, is one where we do have border disruptions in the short term, and we have more financial stress showing up in higher credit spreads. The numbers for that tell you that relative to our baseline, we're looking at about 3 to 4 percentage points reduction in GDP. Now, again, we just have to reiterate that the environment is changing rapidly, and then the scenarios might be different, but that's what we have at this point. To your question on modern monetary theory, we will start by saying that we believe that there is a very important role for fiscal policy in macro stabilization, for redistribution, for equity considerations. So fiscal policy is a very important part of the toolkit for policymakers. Now that said, there is no free lunch. There are limits to how much countries can spend. Using money financing to finance fiscal deficits has been tried in the past in many developed countries and in developing countries, and the experience suggests that that usually ends up with uncontrolled inflation, with a collapse in investment, with a collapse in growth. And so I think it's very important to be, while fiscal policy is a powerful tool, I think it's very important to be careful about the financing that's used for it. And it is history that has taught us the value of central bank independence to maintain stable economies, and we think that's an important lesson to keep in mind.
Thank you, Gita. So we have time for 2 more questions, so I'm going to start with the gentleman here in the front row.
Thank you. A bit of a 2-part question, if I may. The first on monetary policy, the second on fiscal. On the monetary policy side, I think we came into this year expecting to see quantitative tightening or a resumption of normalization from central banks. As you talked about in your remarks, that hasn't been seen, and in fact, we've seen more easing from central banks. And I wonder if, in your outlooks, looking forward in terms of 2021 and further than that, how do you factor in the potential strain from the extension of this unorthodox monetary policy that we're seeing continue? The second question on the fiscal side is we've seen democracies find it harder and harder to pass regulations, to pass further things like stimulus. We've also seen an increase in leaders like Lopez Obrador, like Erdogan in Turkey, a couple others, Bolsonaro in Brazil, like you've mentioned. How do those things factor into both your short-term and long-term outlooks?
Thank
you. So on your question on monetary policy, it's indeed the case that there has been a pivot with the Fed, with the pause and the expectation of a rate rise in 2019. And so that's an important event that we believe has taken off some of the downside risks that were building up towards the end of 2018. And so the pause, which was data dependent, was welcome. It is indeed the case that we have to look forward and see how this plays out. That would again depend upon the data that's coming in. If we do have the recovery that we are projecting by 2020, that could change the policy stance. This policy certainly has led to resumption of capital flows to emerging markets, so there's been a positive impact there. I mean, there's been some resumption, not a tremendous resumption, but some resumption. But that, again, I think it's important to keep in mind that we still live in an environment with high levels of public and private sector debt, so there are financial vulnerabilities that are still there and still building up, which is why our advice is to use macroprudential tools at this stage to make sure that these stay contained. Fiscal policy is a very important part of our the assumptions that we make going forward for both the short term and the long term, and it varies across countries. It's country specific. Some have the space, some don't. Policies vary, but it is a very important part of our when we try to make our projections about what's going to happen to growth, both in the short term and in the medium term.
Thank you, Gita. So we're going to take one last question here from the gentleman in the first row. Yes, please.
Thank you. I'm Michael Ignatiou from Orpea TV, Greece.
but my question is on Turkey. There are a lot of information around that in the summer, Turkey is going to knock the door of the IMF. Can you tell us what is your prediction? And if the IMF has the money to save Turkey, the Turkish economy? Thank you.
I mean, we have no reason to think that Turkey is even contemplating coming to the IMF. So that's where we are at this point. The Turkish economy is certainly under stress. They've used monetary policy tightening to contain the effects on inflation and on the exchange rate. We've certainly seen an improvement in their trade balance, so net exports have grown, and this has been mainly driven by a compression in imports and less so by exports in Turkey. So we are seeing some adjustments, but it is, I mean, our forecast for Turkey is that this year there would be negative growth, but then we're expecting a recovery in 2020. And in fact, this recovery is an important part of the element that goes towards the whole global recovery.
All right. Well, with that, I would like to thank you very much for being here. Thank you to the speakers. Tomorrow we have two press conferences, the Global Financial Stability Report and the Fiscal Monitor. So see you tomorrow. Thank you so much.